Whether you make profit or you don't make profit, you are supposed to pay interest to the debenture holder because you have taken the market value, the market price of the equity share will also be high in the company. So these are the, if you don't have profit at all, how is that you will actually make a return earning? So that is why it is called uncertain source of fund. So he will not ask for money immediately. That is what the trade credit is. Always in the business, you are supposed to help each other. Hello everybody, a warm welcome to one and all. I'm Vidhyaashram from the Department of Business Studies in Vidhyaashram PU College, the Temple of Excellence. Welcome to the 8th chapter and 3rd session of Sources of Business Finance. In this topic, we'll go with retained earning. I told you in the session 2 that what exactly the retained earning is all about. So, retained earning in the sense, sometimes the company will not give all the dividends to the shareholder. What they do is they keep some of the dividends to themselves and then they distribute the remaining. So whatever they have kept it for themselves, we call that as retained earning. And retained earning is always a permanent source of income for the business. A company generally does not distribute all its earning amongst the shareholders as dividends. So you have equity shareholder, then you have preference shareholder, you have debenture holder, debentures, that is debenture holder. Now what happens is, whether you make profit or you don't make profit, you are supposed to pay interest to the debenture holder because you have taken loan from them. After whatever it is, the leftover is there, that leftover will be given to the preference shareholder. So that is, first is debenture holder, second is preference shareholder. Why they are getting the shares, in the sense the dividend, before the equity shareholder? Because they have something called preference. They have a preference over equity. So after that, whatever is the left amount, right, that will be distributed to the shareholders who have taken equity, the third one. Now here what happens is, every time the equity shareholder, they have a problem because even though the dividend are more, the profit earning from the company is too much, but still equity shareholder will not get the full amount, because the debenture holders will take, then the preference shareholder will take, and if something is left, then the equity shareholder will actually take it. So here what happens is, before distributing to debenture, preference and equity, the company will actually have something called retained earning. That is, they'll keep the earning, some part of the earning, and then they'll start distributing it to the debenture holder, preference holder and the equity shareholder. A portion of the net earning, what is it? A portion of the net earning may be retained in the business for the use in the future. Why will they retain it? Because we don't know what the future is, how the future will look like. We really don't know. So what here happens is, you need to understand that life is full of uncertainty, risk. So business is also, it deals with the same kind of a risk, like more risk, more uncertainty. So what happens is, last year they have made more profit. So the last year itself, they'll plan for the next year. We have this long-term plan, medium-term plan, short-term plan. So retained earning always help in any of the uncertainty or risk time, that we have few necessary kind of earnings which can be actually used where there is uncertainty and losses in future. So that is why it is called as retained earning. You have retained your earning. That is called retained earning. So what are the merits of retained earning? The first merit of retained earning is what? It is a permanent. It is what? It is a permanent source of fund available to an organization. So for any organization, retained earning is always what? It is sure that if you make profit, you will actually retain it. So it does not involve any explicit cost, unnecessary any cost. It is not incurring in the form of interest, dividend or flotation cost. I'll tell you more about what exactly a flotation cost is all about. As the funds are generated internally, when the funds are generated internally, when we spoke about the funds on the basis of generation, we had something called internal, and we had something called external. What was that? Internal and external. So as the funds are generated internally, so retained earning is what type of fund? It is internal fund. There is a greater degree of operational freedom and flexibility internally. See, when you are getting more money internally, so what happens is you'll have a confidence over, and it will be what, flexible also, and the operational things will also be very easy. The next merits are, see, there are 5 merits. It's a 4-mark question. Explain the merits of retained earning. You are supposed to write the meaning and then you are supposed to go with these points. It enhances the capacity. Please understand this. What exactly happens is it enhances the capacity of the business to absorb unexpected losses. Whenever there is a loss, unexpected, right? You have retained earning and it can actually match those losses. That's why you are supposed to have retained earning. And lastly, we have, it may lead to increase in the market price of the equity shares of a company. See, when you have more retained earning, what happens is, you will have something like the market price of the equity shareholder, the market price. Please understand, there are 2 prices. One is the face value, one more is market value. The more you have fund within your company, when people or the general public will check that how much is your retained earning and it is too much, that means they have confidence over the company. When they have confidence over the company, they start buying the shares of the company, because retained earning itself is in crores together. So they feel that even if they make a loss, the earnings are there, they have savings and can actually match it. That's why the market value, the market price of the equity share will also be high in the company. So these are the merits of retained earning. So what exactly we got to know? We got to know that retained earning is a permanent one. Then it does not involve any expenses cost. You don't have any extra cost. Then we have internally, it is actually one of the best policy which they actually go with. Then we got to know about the capacity and the absorb unexpected loss. It can around say absorb the unexpected loss. And the last one is, yes, market value or the market price of the equity share will also go up. But there are something called limitations as well. So what are the limitations of it? Excessive plowing, right? Excessive if you are taking from the shareholder, the dividend, right? Back may cause dissatisfaction. See, the equity shareholder, he feels that why should they retain the earning now? Why could they not do it before? Now I have invested in this company. Now the company is making profit. Now I am the person who should get all the dividend. Why is that the company is holding the amount? That is what they'll feel. That means excessive flowing back, excessive, only in the case of excessive flowing back may cause dissatisfaction among the shareholders, as they would get lower dividends. They would get what? Lower dividends. It is an uncertain source of fund. When I say it is certain or uncertain, I'll tell you retained earning is always uncertain, because it depends on the business, how the business is there. It depends on the customer, whether they are buying the product or not buying the product, whether the company is making profit or not. If you don't have profit at all, how is that you will actually make a retained earning? So that is why it is called uncertain source of fund, as the profit of business are fluctuating. It depends on the profit. Next is the opportunity cost associated. What is it? The opportunity cost associated with these funds is not recognized. What is it? It is not recognized by many firms. This may lead to suboptimal use of the fund. Sometimes what happens is you will not optimally use it. You will not use it for sure. What exactly happens is the more the profit is, retained earning will be kept in more bulk, but the profit is less, then what happens is the retained earning will also slow down and you will not have the retained earning at all. And next is the opportunity cost associated with these fund is not recognized. I told you earlier, it is not recognized by many firms. This may lead to suboptimal, what is it? Suboptimal use of the fund. So let's go with the next topic, that is called trade credit. Now trade credit, the word trade and credit, I'll tell you what exactly it is. A trade credit is the credit extended by one trader to another. That means there are two people. Now here trader, here also you have a trader. So what happens is trade credit is the credit extended by one trader to another trader for the purchase of goods and services. If he does not have money, so this person is giving him the trade credit. Trade credit facilitates the purchase of supplies without immediate payment. So he will not ask for money immediately. That is what the trade credit is. Always in the business, you are supposed to help each other. Such credit appears in the record of the buyer of goods as sundry creditor or accounts payable on his book of account. In his books of account, he will actually write that as sundry creditors or accounts payable. So what are the merits and the demerits? Let's check. The merits are trade credit is the convenient. What is it? It is a convenient and continuous source of fund. Trade credit is what? It's a convenient as well as it is a continuous source of fund. Trade credit may be readily available in case the credit worthiness of the customer is known to the seller. So whoever is a seller, if he gets to know it, it will be really good. Trade credit needs to promote the sales of an organization. How exactly the sales are happening? You are supposed to get it promoted. Next is the limitations. Let's check the limitation. Availability of easy and flexible trade credit facilitates may induce a firm to indulge in over trading. When they are getting for free, right, what usually happens is it can influence them for over trading, which may add to the risk of the firm. So when you are getting more credits, what you do is you actually go for it, but in the long end what happens is it is always a risk to the firm. Only limited amount of funds can be generated through trade credit. You can't actually generate too much from trade credit, only limited. And the last one is it is generally a costly source of fund. See, when one person is giving a trade credit to the other person, he really requires something called interest, and he will charge what? More interest. That is why it is what? It is very costly source of fund as compared to most other source of raising money. Now when a trader is giving another trader the trade credit, what happens is the trader who has taken the trade credit, he can actually go to the bank and he can get it, and the interest rate will be less. But it's only in the emergency case of a thing. It is what? Very convenient, flexible, the way they go with their understanding, the trade credit is given. But it is what? It is very, very costly. Please understand, in the books of account, what exactly they'll write? They'll write it as sundry creditor or account payable. So these are the things which you are supposed to know. Thank you so much, students, for understanding all the topics. If you have any doubt, you can easily contact us. We are always there to help you. I'll see you when I see you.